Aloha, this is Kurt Nielsen with eMortgage Hawaii, and today I've got a short video for you that may help you with your clients, and you might want to share this video with your clients. And it's really a discussion about whether you should buy now, lock in today's low rates, or wait for real estate prices to possibly dip a little bit more. And what's the pros and the cons for doing both? So this is really a discussion about interest rates versus real estate prices. And it's for those clients that are waiting to buy at a lower price. However, it's extremely important for clients that are going to be buying real estate with borrowed money that interest rate is just as important as the price that they pay for the property. And I'm going to go through some numbers and an example that will show you that there's a lot more risk in interest rates going up versus the benefit of a possible further decline in real estate prices. Especially for the Hawaiian real estate market, I'm going to show you that waiting for a lower home price will most likely cost most buyers significantly more over the life of the loan if mortgage rates increase, which they already are starting to show that those signs of increasing. Now remember that mortgage rates hit the historic low on February 2nd of this year, February 2nd of 2012, and are beginning to rise. And as the economy of the United States begins to show more life, the interest rates will follow the stock market. So as the economy picks up and the stock market goes up, so will interest rates. This is a chart that shows the 30-year fixed rate over the past 6 months. And as you can see, we had a long precipitous drop in the 30-year mortgage rate up until February 2nd. Now we're starting to see this little trend going upwards. Now I'm not sure if we're going to see that bounce around, maybe even come back down, but I think that when you've hit the historic low of all time, the odds are that interest rates are going to start creeping up. It won't happen all that quickly most likely, but I think it's something that your client has to consider. Now remember that our rate today at eMortgage Hawaii is down here at 3.75% still on the purchase of a second home or a primary residence. Now if you look back over the last 18 months, you can see that only 12 months ago the 30-year fixed was at 5%, and now we're all the way down here at 3.75%. It's 1.25% lower, and that can happen fairly quickly. It could be 90, 120, 180 days before the interest rates get back up to 5% and maybe even go quite a bit higher. It all depends on the economy. As the economy strengthens, the interest rates will also rise. So let's go through a loan scenario. This is John Smith, a fictitious transaction, but I just want to show you the impact of the numbers. So let's suggest that John Smith has an annual income of $75,000 a year, or $6,250 per month. The Smiths currently have a car payment of $350 a month and some other credit card payments of roughly $175 a month. So total other debt is $525 a month. Now remember that you have to meet a debt-to-income ratio of 45%. Sometimes you can get a little higher, but generally that's the limit is 45%. So that means that based on a monthly income of $6,250 times 45%, the maximum monthly debt that the Smiths can have is $2,812.50. Now if we subtract out the $525, that means that their monthly housing expense cannot exceed $2,287.50. Now let's assume some property taxes and insurance of about $425 a month. That means that their monthly principal and interest payment can only be $1,862.50 a month. Now at 3.75%, that translates to a maximum mortgage amount of $400,000. And in this scenario, I'm just going to assume that the Smiths are going to put down the normal 20% down payment. So that means if they had that $100,000, the maximum purchase price that they could afford based on all of the numbers is $500,000. Okay, so let's look at the difference between today's interest rate and a possible rise in interest rate just to 5%. And remember, interest rates could be up to 6, 6.25, 6.5, maybe in 12 months, who knows. So if we look at today's interest rate, the total monthly housing expense for the Smiths would be $2,277. Now, if interest rates went up just to 5%, that payment would now be at $2,572.29. That's $294 more a month that they have to pay for 360 months just because the interest rate went up by 1.25%. And that's not a lot. Now, if the Smiths don't have unlimited income, which in this case, this scenario they don't, they would have to regroup and look at a different house if interest rates went up to 5%, because they can only afford a loan at 5% of $345,000, so $55,000 less. And again, if they put a 20% down payment, that's basically a purchase price about 14% lower than they would have had prior. So if we look at this analysis of the debt to income, again at 3.75%, their debt to income maxes out at 45% here. If interest rates went to 5%, they'd be way above it, 49.6%. So they would have to target a lower valued home, again about 14% less in value. From $500,000, they'd probably be around $445,000, and that brings their debt to income back down to the 45%. Okay, so this kind of summarizes that reduction. So again, at 3.75%, they can afford a $500,000 home. At 5%, their payment would go up so substantially that they would not be qualified for that loan. Now, some buyers might be qualified for that loan, but they'd be paying roughly $300 more a month for the life of the loan. That's about $100,000 that they would pay in addition to the normal mortgage at 3.75. So it'd be about a $100,000 differential in the life of that loan. And this kind of demonstrates that the additional payment of $294 per month for 360 months causes the buyer to pay $106,000 more over the life of the loan. Or if they don't have unlimited income and are limited to the monthly payment of $1,852 or $1,853, they would have to look for a home about $431,500 versus $500,000. Again, that's a 14% reduction in their buying capability on that home. Now think about that. Do we really believe that the Hawaiian real estate market is going to decline another 14% anytime soon? We're seeing stabilization, at least on Oahu, and certainly we're beginning to see it on the outer islands. So let's look at a summary on the importance of rates. Oahu's average home price dropped only 0.7% from 2010 to 2011. So how much further are home prices going to drop on Oahu? Probably not much, and you're certainly not going to see a 14% drop, that's for sure. The outer islands last year dropped, on average from 3 to 4%. So again, just to make up the difference, you would have to wait 3 or 4 years of continued real estate declines to make up that 14% loss in buying power. And in 3 or 4 years, rates might not be at 5%, they might be at 6 or 7%. Again, indications that are that home prices are stabilizing statewide, certainly in Oahu, and the outer islands typically follow Oahu, so maybe a year later. So perhaps in 2012, the outer islands will only see a 0.7% drop in real estate prices. Buyers who are still on the fence are more at risk of seeing higher rates than lower home prices, and that is certainly true. In because rates are so low right now, just a 1 point shift in interest rates, again, or a point and a quarter, can reduce the buying power over 14%. And I've seen interest rates move very, very quickly. It might happen in 90 days, 120 days, maybe 180 days, but that puts us in 2012. We might see 5% rates. I think I've covered this, that a rise to 5% reduces the buying power of the homeowner about 14% based on the sales price and a leverage of 80%. Imagine the impact at 6%. Well, I ran those calculations, and that would reduce the Smith's buying power a full 23%. So you'd never see that kind of reduction in home prices in any reasonable amount of time. And again, we're starting to see stabilization. So that gives you an idea of how we look at the risk of interest rates rising versus the benefit of waiting for lower home prices. I just can't see a scenario where you're actually going to benefit if you're leveraging the property and borrowing money, where you're going to benefit from waiting any longer, because we're at historically low rates. The market is showing stabilization, inventories are dropping, and the economy is starting to show life, and we are beginning to see that in the interest rates. Share this with your clients, and if you'd like to call me and discuss this further, I'd be happy to do that.